Hello everyone, welcome to the market opening bell on Wednesday, February 4th, your 10-minute guide to the stock market. Commodity markets and overseas stock markets rose while Hong Kong stocks fluctuated positively. The Hang Seng Index opened higher by 220 points and climbed as much as 350 points in the early session, briefly reaching a high of 27,126 points before pulling back. It even dipped into negative territory at one point, falling 343 points to a low of 26,431 points, but recovered its losses before midday. The index closed the day up 59 points or 0.2% at 26,834 points. The Hang Seng China Enterprises Index fell 27 points or 0.3% to close at 9,053 points, while the Hang Seng Tech Index dropped 59 points or 1.1% to 5,467 points. Total market turnover for the day reached 335.1 billion Hong Kong dollars. Southbound funds recorded net buying of $952 million in Hong Kong stocks. Among the notable flows, there was net buying of Tencent amounting to 1.955 billion. The CSOP Hang Seng Tech Index ETF at 669 million. China Mobile at 407 million. Xiaomi at 329 million. Hua Hong Semiconductor at 256 million and XXF Group at 157 million. On the selling side, net outflows included Tracker Fund of Hong Kong at 3.763 billion, SMIC at 1.577 billion, Alibaba at 1.198 billion, Kuaishou at 367 million, Meituan at 240 million, and YOFC at 172 million. According to statistics, Southbound funds have been net buyers of Xiaomi for 4 consecutive days, totaling 2.163 billion, while they have net sold SMIC for 7 straight days, amounting to 2.966 billion. Technically, the Hang Seng Index filled a small portion of the downward gap from Monday. That gap spanned 284 points between 27,384 and 27,100 points. The index briefly reclaimed the 10-day moving average at 27,064 points and the 20-day moving average at 26,838 points, but ultimately closed below both lines. In the short term, it is expected to fluctuate between 26,500 and 27,100 points. The 3 major A-share indexes opened higher but initially turned lower before gradually recovering and reversing the previous day's declines. The Shanghai Composite Index closed up 51 points or 1.3% at 4,067 points. The Shenzhen Component Index rose 302 points or 2.2% to 14,127 points, and the Chinex Index gained 60 points or 1.9% to 3,224 points. Total turnover across the Shanghai and Shenzhen markets reached 2.54 trillion yuan. The central parity rate of the renminbi against the US dollar was set 87 pips higher on the day at 6.9608 per US dollar. Tencent opened flat but fell as much as 6.3% earlier on, dipping to a low of $561 before paring some losses to close at $581, down 2.9%. Baidu slid 3.6%, while Alibaba and Meituan fell 1.4% and 1.7% respectively. Kuaishou and Bilibili declined 4.5% and 2.6%. The collective drop in internet stocks stemmed from investor concerns that following the VAT increase on value-added services for Chinese telecom operators, internet service companies might face similar hikes, with speculation that the tax rate for the gaming industry could rise from 6% to as high as 32%. However, such claims appear to be over-extrapolations without solid evidence. China's VAT law clearly stipulates that the maximum VAT rate is only 13%. making a jump to 32% for gaming implausible. Moreover, the value-added tax law of the People's Republic of China draft for comments is set to take effect on January 1st, 2026, and it specifies 1. Basic telecommunications at 9% already increased. 2. Sales of services, intangible assets and financial products at 6%. And 3. Zero rate for cross-border sales by domestic entities and individuals of services and intangible assets within the scope stipulated by the State Council. Financial and internet services such as gaming and advertising currently apply the 6% VAT rate. Separately, another bearish factor for tech stocks was news that Tencent, following other tech giants, is distributing electronic red packets to attract users to its AI product Yuanbao, sparking market worries about an intense price war among Chinese tech heavyweights. According to multiple media reports since the second half of last year, various tea, beverage and restaurant brands on the mainland have gradually adjusted their takeaway prices, including Luckin Coffee, Nayuki's Tea, Misha Ice Cream and Tea, KFC and McDonald's. Coty Coffee has also reduced its full menu 9.9 yuan promotion starting this month. Reports indicate that KFC China's delivery product prices rose by an average of 0.8 yuan. The Western restaurant brand Saizeriya increased prices on some dishes by 1 to 2 yuan. Luckin Coffee began reducing the proportion of 9.9 yuan items last year, with most drinks now ranging from 10.9 to 13.9 yuan. And Nayuki's Tea raised breakfast prices in its Guangzhou and Suncheon stores from 9.9 yuan to starting at 15.9 yuan. An article by a special commentator in Beijing's Qiushi magazine titled "Actively Promote a Reasonable Rebound in Prices" pointed out that the persistently low prices can alter people's expectations about future economic trends, creating a vicious cycle of low prices, weak expectations, reduced consumption, low corporate profits, low resident income, weak expectations, reduced consumption, low prices, which in turn suppresses investment willingness. For today's debut, Guoen Technology closed at $47.2 in the pre-listing grey market session on Philip Mart yesterday, representing a 31.1% premium or $11.20 above the IPO price. Excluding fees with 200 shares per lot, this translates to a paper profit of $2,240 per lot. On the topic of new listings, artificial intelligence has become one of the key themes in Hong Kong's IPO market this year. The Hong Kong Exchanges and Clearing Limited stated that in December last year and January this year, 12 new companies across various segments of the AI value chain listed in Hong Kong, covering AI applications and AI infrastructure, collectively raising over $4.9 billion. Among the cases currently submitted for listing approval, around 20 companies in various AI value chain areas are involved, with most belonging to platform domains such as enterprise AI, marketing AI, data and business intelligence solutions, and other software-centric applications. The U.S. House of Representatives narrowly passed a new spending plan by a vote of 217 to 214, ending partial government shutdowns. U.S. stocks showed mixed performance early on, but ultimately closed lower across the board. The fear gauge fixed index rose 1.7 points or 10.2% to 18. The Dow Jones Industrial Average broke to a new high shortly after the open, touching 49,653 points, but then swung erratically, falling as much as 574 points or 1.2% at one stage, before closing down 166 points or 0.3% at 49,240 points. The S&P 500 fell 58 points or 0.8% to 6,917 points, and the Nasdaq Composite dropped 336 points or 1.4% to 23,255 points. The Nasdaq China Golden Dragon Index, reflecting Chinese concept stocks, declined 71 points or 0.9% to close at 7,610 points. Microsoft and Meta both fell more than 2%. Apple dipped 0.2% and Nvidia dropped nearly 3%. Reports indicate that OpenAI was dissatisfied with some of Nvidia's latest AI chips and has been seeking alternatives since last year. The shift in strategy reportedly emphasizes chips used for specific AI inference stages, the process where AI models respond to user queries and requests. Nevertheless, Nvidia remains dominant in chips for training large AI models. Software stocks continue to underperform, with ServiceNow hitting a 52-week low and closing down 7%, while Salesforce also fell close to 7%. Among earnings releases, the AI concept defense stock Palantir delivered strong fourth quarter results and optimistic guidance, sending its shares up nearly 7%. PayPal, which reported quarterly results before the market opened, missed revenue expectations and announced a CEO change, causing its stock to plunge 20% and hit a 52-week low, making it the worst performer in the Nasdaq index. PepsiCo rose about 5% after reporting fourth quarter net profit growth of 67% year over year to $2.54 billion. Core earnings per share, excluding one-time items, rose to $2.26, slightly above the market's expected $2.24, ending 3 consecutive quarters of core EPS declines. Quarterly revenue grew 5.6% to $29.34 billion, exceeding the expected $28.98 billion, driven mainly by a 4.5% increase in average prices, while volumes fell 2%. The company reiterated its full-year organic revenue growth guidance of 2% to 4% and maintained core EPS growth of 5 to 7%. Pharmaceutical company Merck reported fourth quarter revenue of $16.4 billion, up 5% year over year and above the expected $16.2 billion. Adjusted earnings per share came in at $2.04, beating the $2.01 forecast. However, its full-year revenue guidance fell short of expectations, projecting $65.5 billion to $67 billion versus the market's $67.4 billion, with adjusted earnings per share at $5 to $5.15, well below the expected $5.27. Pfizer swung to a net loss of $1.65 billion in the fourth quarter, or a loss of $0.29 per share, compared to the net profit of $410 million or $0.07 per share in the same period last year. Adjusted earnings per share was $0.66, above the expected $0.57. The decline was due to reduced demand for its COVID-19 vaccine and antiviral Paxlovid, with revenue falling 1% year over year to $17.56 billion, but still above the expected $16.95 billion. Pfizer guided for 2 to 6 adjusted earnings per share of $2.8 to $3 and total revenue of $59.5 billion to $62.5 billion. After 3 consecutive days of declines, international gold and silver prices staged a sharp rebound. Spot gold surged more than 6% to $4,948 per ounce, while April gold futures briefly reclaimed $5,000, hitting a daily high of $5,018. March silver futures rose 13% to $86.9 per ounce. The World Gold Council's full year 2025 global gold demand trends report showed that global central banks added 863 tons of gold to their reserves in 2025. Although total demand did not exceed the average of over 1,000 tons per year seen in the previous 3 years, central bank purchases remain a major driver of global gold demand in 2025, providing incremental support to overall demand. Our stock pick today is TS Line, stock code 2510. TS Lines primarily engages in providing container shipping services. Its fleet consists of both owned and chartered vessels, with a continued focus on the Asia-Pacific region as its core operating area. The service network covers major routes including Greater China North Asia, Greater China Southeast Asia, Northeast Asia, Southeast Asia, Asia Oceania, and Asia Indian subcontinent. While continuing to deepen its presence in regional markets, the group is also actively expanding into long-haul, high-value routes with operating focus extending to trans-Pacific routes, the Middle East and East Africa markets. Starting from April 2025, it officially launched the Asia-Mexico route, further expanding into the Latin American market to broaden its global service footprint and diversify its revenue structure. As of the end of June 2025, the group operated a total of 49 routes, including 11 self-operated routes, 24 joint service routes, 11 slot exchange routes, and 3 slot purchase routes. Its shipping network already covers major trade markets in Asia, serving a total of approximately 22 countries and regions worldwide, calling at about 60 ports in aggregate. The group operates a total fleet of 47 vessels with a combined capacity of 140,726 TEU. In terms of fleet composition, there are 34 owned vessels providing 81,129 TEU of capacity, with an average age of about 3.8 years. Additionally, there are 7 owned vessels on sub-charter, totaling 37,149 TEU, with an average age of 6.8 years. Chartered-in vessels number 6, providing 22,448 TEU of capacity, with an average age of only 2.2 years. Multiple new vessels, including 7,000 TEU and 14,000 TEU vessels, are expected to be delivered successively in 2026 and 2027. Overall, the group's fleet structure is solid, maintaining a high proportion of owned capacity while leveraging the advantage of a young fleet to support service stability and operational flexibility. Relying on its flexible market strategy and the advantages of a young fleet, the group has continued to deliver solid performance amid overall market volatility. In the first half of 2025, total revenue reached $641 million, representing an 18.7% increase compared to the same period in 2024. The Asia-Pacific market remains the group's primary revenue source, accounting for 83.4% of total container shipping service revenue. Profit attributable to shareholders was $188 million, representing a substantial increase of 222%. The gross margin improved from 8.7% in the same period of 2024 to 19.8%, mainly due to the average freight rate rising faster than the increase in cost of sales. The current forecasted PE ratio for 2025 is only about 4 times, with the forecasted PE for 2026 expected to fall below 4 times, significantly lower than the industry average around 9 times, and the dividend yield reaching 10%, Recommended buy price $8.70, target price $9.50, stop loss level $8.30. I do not hold the above stock.